Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we've got Carley Garner. This is actually her second time doing a presentation on BMT, and the first presentation she did was kind of a more basic overview of options trading. This time we've asked her to come back and get a little bit more detailed, a little bit more complex, and take us a little deeper. So with this one we're calling Options Trading 201. Some of the topics that Carley wanted to cover today include short options to finance long options, selling options to provide room for error in futures positions, trading debit spreads, adjusting bull call and bear put spreads with additional premium collection, and some trading examples that include the risk and break-even analysis. Carley's also mentioned that she'll take questions as we go. So as you guys see something that you have a question about, just go ahead and type it, and we'll try to get that answered as we go along through the presentation. I do want to remind everybody that the webinar is being recorded, and I'll post the recording sometime tomorrow on BMT. I will also be sending it to Carley so she can send it out to all of her followers. If you are watching it on YouTube, do us a favor and hit the thumbs up if you like it. And if you're watching it on BMT later, give me some feedback. The feedback form is right below the video when you're playing it back. All right, guys, 1 second, and here comes Carley. Sorry, that was my phone. All right, here comes Carley.
As you mentioned, we're going to talk about option trading. Hopefully you saw part 1 of this class. If not, that's okay. I mean, hopefully you'll still get something out of it, but I highly recommend, if you haven't, to go back and watch part 1. It should be posted on Big Mike's trading forum. It's also on DeCarley Trading, so whichever is easier for you to get to, you'll find it there. All right, first and foremost, I want to remind you that there is a substantial risk of loss in trading futures and options. And tell you what here. Okay, that's better. Once again, we're not investing. We are not guaranteed some sort of coupon payment or interest. We're trading. It's speculative. You're going to win some. You're going to lose some. It's just part of the game. Hopefully you win more than you lose. That's the idea. And because it's speculative in nature, it's not suitable for everybody. I always remind people you should be trading with risk capital only. If you cannot afford to lose the money that you have in the account, you probably should not have it in the futures market. And that's not to say that if you have it in the futures account, you're definitely going to lose it, but you want to have that mindset that it is possible for that to happen. My name is Carley Garner. I work for DeCarley Trading in Las Vegas, Nevada. We are a branch of the Zaner Group. I know that gets a little confusing, but basically what we are is we with Zaner are like a mini brokerage firm, and we work with about 8 different clearing firms. So in other words, the easiest way to explain it is we're an introducing broker, which means in English, we basically are contractors. We're 1099 instead of hired as employees to be brokers for various brokerage firms. So when you come to an introducing broker such as ourselves, what we do is we help people find the appropriate trading clearing arrangement, the appropriate platform, give them trading ideas and research and those types of things. If you're interested in anything that we do, you can check us out on Facebook and Twitter. We put out a lot of charts and commentary and just random things, free educational offers, stuff like that. So check us out on the social media sites. Also, if you go to DeCarleyTrading.com, we have a lot of free videos and educational articles and all that kind of good stuff. And if you have any questions after the class or later on, whenever it may be, here's my phone number. Feel free to give me a call or send me an email, and we'll make sure that you get taken care of. I am a broker, a market strategist, and an author. You might have seen my name in Stocks and Commodities magazine. I also write 2 newsletters for DeCarley clients, which are focused on commodities and option trading and things like that. You can sign up for a free trial at our website, DeCarleyTrading.com, if you're interested. And I've written 3.5 books. A Trader's First Book on Commodities, I've written twice. The first one has a yellow cover, the second one a blue cover. So if you go to Amazon or whatever book outlet you're looking at and you see a yellow one, just know the yellow one is the older version, the blue is the new. And I'd recommend that you go with the second edition. It's a little bit more expensive. They charge a few more dollars for it, but it's worth it in the second edition. We've updated everything for, technology has changed, market conditions have changed, things like that. And as far as the topic that we're going to talk about today, we're going to cover a lot of the things that are in my book, Commodity Options. Now, Commodity Options was written a few years ago, and things change fast. It's just how the business works. But the strategies themselves are all the same, and they'll probably never change. So even though Commodity Options, in the book it talks about some things like open outcry option trading and stuff like that, there still is open outcry option trading, and in fact, there's still more liquidity in open outcry options than there are electronic. But for a lot of traders, especially online traders, it's a lot more convenient, and cost-wise, it ends up being about similar nowadays. So things have changed. But just keep that in mind. The strategies are going to stay the same, but some of the details aren't. But we'd be more than happy to answer any questions that you have if you decide to read that book. Even though I'm hoping that all of you saw part one, I'm just going to really, give you a quick overview, and the reason being that's just how my brain works. I have a hard time diving into things without making sure everybody's on the same page. Options are incredibly versatile, and that's the whole. If you walk away from anything in this class, I hope that that's what you walk away with, is just understanding that options provide options. Through combinations of long and short calls and puts, it's possible to create just about any type of risk and reward and leverage strategy that you could possibly imagine. There's two types of options, and all of you probably know this, but again, I'm the type that has to start with point one before I can get to point two. There's a call and a put, and I'll be real quick, by the way. A call option is basically the right or the option to buy the underlying futures contract, or stock if you're trading stocks, but it's to buy the underlying asset at a specific price at a specific time in the future. And when you buy a call option, it's bullish. A put option is the right to sell at a specific price at a specific time in the future, and that's a bearish strategy. The option premium is nothing more than the price of the option. It's the price paid by the buyer to the seller. Oops, sorry about that. I didn't mean to do that. The price paid by the buyer to the seller for the right to buy or sell the underlying futures contract at the stated price, and the stated price is the strike price. So a lot of people get those two things mixed up a little bit. When you're talking about an option, there's really two prices. There's the price that's the value of the option, and then there's the price at which the option becomes valid. And the price at which the option becomes valid is the strike price. A couple things we need to know about premium real quick before we get into buying and selling is in higher market volatility, you're going to see higher premiums. If there's more time to expiration, that also equates to higher premiums or more valuable options. Another thing that a lot of traders kind of tend to overlook is that demand can increase the value of an option beyond what can be justified. So for example, if a news station, CNBC or Bloomberg, whoever it is, starts talking about corn prices and they show pictures of dry fields and in Indiana, what happens? Well, speculators see the newscast and they decide maybe now I should be buying corn. Now with that said, that's probably the exact worst time for them to be bullish corn is when you see something like that on TV, but unfortunately that's just the nature, it's human nature. And so what will happen is you'll see the call options increase in value because people are speculating on, maybe they're right. If there is this type of drought, maybe corn prices are going to go higher. They buy calls. So the increase in demand alone is increasing the value of the options. And it doesn't have anything to do with fundamentals or anything else. It's just human emotion. You can't forget that markets are really moving on. They're not moving on logic. They're moving on human emotions. In general, you want to be a net buyer when volatility is low. When markets that aren't getting a lot of attention, there's low demand for options, the volatility is low, and what did I say when there's low demand and low volatility? That means the options are usually cheap. So that's exactly when you want to be a net buyer of options. You're going to want to be a net seller of options when the markets are highly volatile and there's a lot of hype surrounding the market, meaning that there's high demand for options. I mean, it's as simple as buying low and selling high. You hear that all the time, right? It sounds easy. It's not as easy to actually implement, but that's the idea. You always want to keep that in mind. When things are quiet, you want to be an option buyer. When they're rowdy and the markets are moving, you want to be an option seller. The long and short of options. Options are eroding assets. Each minute that passes reduces the value of any particular option. Buying an option is similar to buying a car, watching the value plummet as it's driven off the lot. Time works against the buyer but in favor of the seller. And this is really key to what we're going to talk about today when we're doing option spreads, when we're buying options and selling options together to form a common goal. We want to make sure that we understand that the reason we're doing this is because most options expire worthless and most options are priced to lose. They're eroding assets to the buyers and they're eroding liabilities to the sellers. Just as a real quick overview, a long option strategy, meaning you're long more options than you're short of the same type. When I say same type, I'm talking calls or puts, not necessarily strikes or anything like that. But if you're long more calls in the same market than you're short calls, then you're playing with a long option strategy. And that has limited risk, unlimited, well, possibly unlimited reward if you're just buying an outright call option. And that sounds great on the surface, but the problem with that is options are eroding assets. Time's working against you, has unfavorable odds, more options than not, maybe 80%. There's been a lot of studies, and some say 70, some say 90, and everything else in between. But most options are probably going to expire worthless. And again, it's similar to buying insurance or lottery tickets where you pay a little bit of premium for the chance of something happening. The chance of that happening is slim to none, but if it does, it could pay out big. That's the idea of buying an option. When you're selling an option, you're taking the other bet. You're collecting that little bit of premium, hoping that the big payoff isn't coming to the buyer. When you're selling options, you have unlimited risk and limited reward. And on the surface, that doesn't sound like a very good deal, but as we'll show you later on, maybe it's not such a bad deal. I mean, the odds are in your favor, even though you don't have unlimited profit potential or unlimited reward. Maybe a little here and a little there will add up to be something more than what maybe you would have gotten if you would have bought the options, which is most likely nothing. What is an option spread? Okay, now we're going to get into the new stuff. I hope I didn't bore you with the recap. Well, an option spread is a combination of long and short options that work together toward a common goal. This often involves a primary long option, which is surrounded by short options to finance the trade. The primary long option determines whether you're bullish or bearish. In other words, are you buying a call and selling premium around it to pay for it, or are you buying a put and selling premium around it to pay for that? When you're trading spreads, the position is inherently hedged. As the market goes up or down, some legs of the spread are going to benefit while others are not, and vice versa. So the idea is the spread gives you balance. It's not going to be an all or nothing ordeal. If the market goes up, you're going to be losing on part of it, but you're going to be making on part of it, so on and so forth. So why would you trade option spreads if you're definitely going to lose on one side of the trade, and that's almost always true. Not always, but almost always true that you're going to win on one leg or two legs, and you're going to lose on one or two legs. So how in the heck can you ever come out ahead? Well, we're going to show you that. But the idea behind trading spreads is that basically spread traders enjoy the best of both worlds. Spread trading enables a reduction of market volatility relative to an outright futures contract. Also, option spreads can be really anything that you want them to be. They can be uber aggressive or they can be extremely conservative, and it's up to you as the trader to put together something that fits your needs and your personality and what you're willing to risk on that particular venture. Spread traders can reduce their cost and arguably their risk through the sale of options around their primary long or call put. So basically we're going to say, okay, we think the market's going up, so we're going to buy a call option. But instead of spending a fortune on that call option, what we'll do is, well, we will spend a fortune on the call option, but we're going to sell calls and maybe sell some puts or something else around it to pay for that venture, to pay for that long call. All right, the primary goal of trading an option spread is really to use the market's money to buy options and not your own. It's almost like when you buy a car again, a lot of times you'll take a loan out to buy that car because you want to use the bank's money instead of your own. You don't want to tie up your own money, but there's an opportunity cost to that, right? You have to pay interest and all those other things, and it's going to go on your credit. But obviously, if you do it, you think it's worth the opportunity cost, and that's the way you should look at an option spread. If you're using the market's money is not free. You're going to have to give something up, and it might be additional risk, or it might be capping your profit potential, or it might be something else. For every option purchased, you're going to want to sell at least one, but maybe two in order to finance the trade. In most instances, if you're only selling one option to finance the trade, you're probably not going to collect enough to make it to do what you need it to do, but maybe you can. I mean, we'll take a look at a few examples and just give you an idea. More often than not, you're probably going to want to sell two options for every one that you buy, but again, every market's different, every scenario is different, so that's something that's up to the trader. And again, the whole idea of these option spreads is that we're attempting to take advantage of the dismal odds that are facing long option traders. First, we're going to talk about ratio spreads. Okay. Ratio spread is one in which a trader simultaneously holds an unequal number of long and short positions. And obviously that can mean almost anything. But the most common ratio is a 1/2, or being short two options for each option that's long with the same option type, and the two short options are typically the same strike price. And this is called a front spread, and I know that's a lot to digest, but so what we're talking about here is, let's say, just hypothetically, if we're looking at crude oil, a ratio spread might be buying let's say a 97 call and selling two 100 calls. That would be a front spread. Now a back spread is the opposite. It's when you're actually selling a close to the money option and then buying two out of the money options that are equidistant to the original strike. I'm not a big fan of back spreads, really simply because it's the kind of trade that, like for example, let me just give you an idea of what that means. Remember on the front spread, I said we would be buying a 97 and selling two 100s. Well, a back spread trader would do the opposite. He would actually sell the 97 and then buy two 100s. The only way that now that particular trade really isn't going to cost much out of pocket, but the only way for it to make money is if there's an explosive move. If the market explodes higher, the trader makes money. But if the market goes down, or the trader really doesn't make anything. If the market goes up, the trader loses. So the trader's going to lose if the market goes the way he wanted it to, but it didn't go enough. And that's, to me, that's a tough game. There's really no limits to the possibilities. Ratio spreads can be constructed in an infinite number of ways. And that may involve limited or unlimited profit potential, but it's always going to have theoretically unlimited risk. And the reason I say that is in a ratio spread, you're always going to be selling more options than you're buying. Well, I should take that back. In a front spread, in a 1x2 front spread, which is what we're going to talk about, you're always going to be selling more options than you're buying. In a back spread, that's not true. The back spread does have limited risk, but again, the odds of making money on the trade are not that great. So to me, it's really just not worth the effort. Now, it's possible. You don't have to do a 1x2. You could do a 1x3 or a 1x4. For example, we'll go back to crude, and this is all just hypothetical. I probably would never recommend a spread this tight, but just for an example's sake, you could buy a 97 and sell 3 of the 100s, or you could sell 4 of the 100s. But the problem with that is, you're actually going to collect a credit. You're going to collect more money on the short options probably than you're paying to buy the long option, and that's great because that gives you the ability to make money if the market goes down, to go sideways, or it goes up. But the problem with that is if you start talking about 4 options to every 1 long, at some point you might get into trouble with, let's say something happens in Iran or something in the Middle East and crude oil's up $3 or $4 in a day. You're going to see the call options just completely explode in value. And if you've got 3 of them or 4 of them, it's going to be a very painful day. And again, I mean, I mentioned this before, but I want you to really understand that the premise of a ratio spread or any other spread is to finance a long option with the premium collected for short options. So assuming that there's more options than not that expire worthless, which is the assumption that just about everybody that I've ever spoke to goes off of, including the exchanges and so on and so forth, the odds of success must be better for a spread in which there's 2 options sold for every 1 than there is just somebody buying an outright option, right? And in most cases, this is true. This is just kind of a vocabulary informational slide, but you're probably going to run into this if you're reading about options or talking about options with somebody. So it's important to know. Depending on the strike prices, the months, the chosen structure of the ratio spread, it can be filled, and obviously filled just means executed, at either a debit, a credit, or at even money. If you're filled at a debit, the trader will actually pay more in premium for the long options than is collected for short options. If it's a credit, a trader collects more in premium from the short options than is paid for the long. And if it's at even money, it's exactly the same. If you're paying $500 for your long option and then you sell a couple options worth $250 apiece, you executed the trade at even money, equal premium for both the long and the short side of the trade. All right, let's start taking a look at the details of a ratio spread. On a 1x2 call spread, you're buying a close to the money call, and then you're selling 2 out of the money calls with the same strike price. Now keep in mind, you can sell different strike prices, but it's not called a ratio spread anymore. It's called something else. And I mean, again, you can imagine there's really just no limit on the types of spreads you can put together. You can be creative. But if you did a 1x2 where you're buying an option, buying a call, selling 2 above the market at the same strike price, that's a 1x2 ratio spread. It's a bullish trade. You're going to be naked 1 call, don't forget, because you're buying 1 and you're selling 2. So if your long option covers the risk on one of the short options, but it doesn't cover the risk on the other. So you have theoretically unlimited risk above the market. Basically, the risk in that trade is in being too right. So you got into the trade for cheap, but the opportunity cost was If you're too right, you might end up actually losing money. It can be somewhat difficult, and again, it depends on volatility and time horizon and things like that. So you can't, options are not a black and white thing like futures are. Futures, you buy it here, you sell it there, you know how much you made or lost exactly. There's really no room for anything. It is what it is. But in options, there's a lot of gray area, and there's just a lot of really, I don't want to say guessing, but you really can't predict the value of options unless you're talking about at expiration. Anytime before expiration, the volatility and the time value and all those types of things, they can't be, there's mathematical formulas out there that will tell you that this is what they think the option will be worth, but they're using today's parameters. As soon as tomorrow comes along and the volatility changes or something changes, the parameters change, and so the input that the information that you were looking at yesterday is no longer valid for today. So just keep that in mind. But my point is, it can be somewhat difficult at times to exit the entire spread with a desirable profit before expiration. In other words, when you're putting on a 1/2 ratio spread, a lot of times you really have to hold it to the last week of expiration to really start seeing your profits come through. If you put the trade on today and the options have, let's say, for example, they have 50 days to expiration, you put the trade on today, the market goes exactly where you thought it was going to go, but it did it in a couple of days, it's quite possible that you really won't see a big profit in your ratio spread, because the long option is making money, but the two short options might be losing almost as much as you're making on the long. So you have to be careful with that. If volatility increases after you get in, you're going to see that your profit isn't necessarily what you would have liked it to see. But it works the other way also. If you're right and the market goes very slowly upward, you're going to see a nice profit built into the spread right away. Okay, so a 1/2 put spread is the exact same thing, but we're using puts. We're buying a close to the money put. We're selling 2 out of the money puts at the same strike price. It's a bearish position, and again, we're naked 1 put because we're long 1, but we're short 2. The risk in a trade like this is being too right. And again, it's the same type of situation. It might not be possible to pull your profit out of the spread if the market volatility increases after you already entered the trade. Now in a second, we're going to look at a chart of, I think it's crude oil is the example we use, so that we'll give you a much better idea of what the payout and the risk is and all those types of things, because I know it's really hard to read a slide and for it to sink in. So we'll look at it visually, and I hope that'll help you out a little bit. Okay, specifically a 1/2 ratio, right? Whether you use calls or puts, it's going to have unlimited risk, it's going to have limited profit potential, but the great thing about it is there's low out-of-pocket expense. You can get into a ratio, right, typically for free. And when I say free, I mean it doesn't cost you anything. It's done at even money or maybe even a credit or a small debit, but it's basically, it's a free trade. It's a free venture into the market. Now, a trade like that, because there is risk and unlimited risk above and beyond a certain point, there will be margin on the trade. So just because it's free doesn't mean that you can put a trade like this on an account that has $100. That's not how it works. But as long as you have the margin for it, then yes, there's really no cash outlay for the trade. And a 1/2 ratio, right, provides a large profit zone. In my opinion, I believe that this type of trade is best executed in a highly volatile market, and that's because you're selling 2 options for every option you're buying, and the idea is you want to sell the options at top dollar. Obviously, when you're buying an option in volatility, so the one option that you're buying is going to be a little overpriced, but hopefully you'll be able to get further and farther, further out of the money and bigger premium for the 2 options that you're selling because you waited for volatility. And with this in mind, I prefer, anytime you're doing this type of strategy, I prefer that you look for markets that are trending in a certain direction, with the short options being counter trend. So if you're doing a 1/2 call ratio, right, You might want to do this when a market that's a little overbought. And trust me, by nature, I tend to be a counter-trend type of person. Again, that's just how my brain is wired. But this particular type strategy, if you try to do it against the direction of the trend, you're probably going to get into trouble at some point because you're going to be selling your two options at a discount. And if volatility ever comes back or the market ever reverses, even though you're right, could end up coming back and biting you.
Hey, Carly. A couple of questions here.
Sure.
Dan asks the question, how much of the Greeks do I need to know? So I'm trying to understand this question. How much of the Greeks do I need to know? That is what has always intimidated me the most about options. Okay. So he's asking just in general about Greeks.
Right. Well, Dan, you might be happy to know that I don't even look at the Greeks. Like, I'm aware of them, and I have them on my quote screen, and I look at Delta a lot, but I really don't pay attention to some of the other stuff, and the reason being is I think they're maybe more useful in stock trading than commodity trading, but that's just a generalization. In commodity trading, the options don't constantly trade, so the data that you get on the Greeks isn't necessarily as pure as maybe it would be in stocks, but even so, my problem with the Greeks is I think they're I think it's something to be aware of and to kind of peek at, but to actually trade off them, I don't recommend it. And the reason being, the Greeks are a snapshot of what's happening today. It's today's volatility, today's inputs. Tomorrow can be an entirely different story. If you were trading crude oil options a few days ago, you know, when all heck broke loose and crude dropped $6 in a couple of days, you know, the day going into that drop, everything was tame. You know, the Greeks were showing certain inputs, theta, and all. You know, people were excited to let theta work in their favor and all this sort of stuff. But the next day it was a completely different landscape and a completely different picture. So even though the Greeks told them one thing on Wednesday, I think it was Wednesday, but anyway, you get the idea. The very next day,
right,
it was all out the water, new situation. So I think you're fine not paying attention to those as much as some people might say.
Okay. Marcelo asked the question, what delta do you look for the 2 out of the money sell calls?
Okay, each market is going to be different, and each trader's personality is different. I typically look at probably a delta somewhere around 20 or so on the short options, but again, it's all situational. Ideally, I mean, I look at premium more than delta, and I look at volatility just to see, you know, what's going on. But the idea is when you do a 1x2, you want to try to get it delta neutral, and obviously the more aggressive you are, the closer to the money you can get and the higher delta your short options will be. If you're a more conservative trader, you're going to get your long option will be further out of the market, and your delta is going to be lower on the short option. So again, it's a personal choice, but I look for 20-25% probably on something like this.
Okay. Thanks, Carly.
Yep, no problem. Okay. Let's see, where were we here? Really the reason being you want to, with a trade like this, going against the trend is not such a great idea because it's, again, you're selling the options at a discount, and when things do turn around, I mean, we all know the trend is only your friend till it ends, and when it ends, it can be real nasty. Imagine, you know, today the S&P was down 27 points, and that was after being up. So I mean, we were like 40 off the highs in the S&P. Someone that would have done some sort, you know, a ratio spread in the S&P would have really been in big trouble because they would have sold their puts when the VIX was really low and the options were very cheap. And then, you know, once the VIX exploded and volatility exploded, the puts would have also exploded in value. So you want to be careful selling against the trend and selling into quiet, low volatility markets. All right, we'll take a look at a little bit of an example here.
One more quick question before we change.
All right, this is...
Sorry.
Yep, sure.
Jose is asking a follow-up. He says, if you don't care about the Greeks, how do you determine an expensive option versus a cheap option? Is that through Vega?
Okay, well, what I do is I actually chart out the futures price, and I take a look at futures volatility. So I look at historical volatility, I look at standard deviations, things like that. And when I see the futures price really starting to move, that's when I start looking at options and option volatility. And what I look for is options that have doubled or tripled or more in value in a couple of days. That's what because once you see an option that goes from, hypothetically it goes from 10 ticks to 30 or 40 ticks in a couple of days, that's when you're starting to see emotion come into it. It's probably not logical, or it's probably not because of the market movements. It's probably more emotional than anything, and that's what I look for. So I tend to just be a little more hands-on. I don't know, but everybody, you have to find what works for you. If using the deltas works for you, then that's that's great. It's just you have to be confident enough and comfortable enough to be able to find the volatility, get into the trade, and not panic. So if that means using deltas and Greeks, then by all means go for it. I mean, in the end, we're probably all doing the exact same thing, just going about it different ways, if that makes sense.
Okay. If he has another question, I'll let you know.
Okay, sounds good.
Thanks,
all right, so on this particular 1:2 ratio, right, and again, this is just a pure, this is just an example. This isn't something we recommended or put out, but I just wanted to show you kind of how the math works. This is a snapshot taken, I'm not sure when this was, maybe a week or two ago in crude oil, probably a couple weeks ago. But anyway, the idea is, good, you can see my cursor here. This is the 102 strike in May crude oil, and this is the 105 strike. So a trader might have looked at this and said, well, at this particular time, crude oil was in an uptrend. The call options were a little overpriced, not dramatically, but overpriced enough to where you could probably get off a decent ratio spread. Now, you want to keep in mind that if you're trading with the trend, a lot of times these ratio spreads they might not work out. But the idea is you're getting into the market for free. So it's kind of like a free shot, and if it does pay off, then that's great. If it doesn't, maybe it's not so bad. Or you could use it as some sort of insurance. Like, for example, you could put a spread like this on and go short a futures contract. So that way you're using the ratio spread as free insurance. So there's a lot of ways to look at it, and remember, just be creative. But let's say that a trader decided to buy the 102, and you can see here for approximately $1.50 or so. And I kind of rounded these numbers, and you'll see in the next slide, just so that the math is easy. But they could have sold two 105s and basically paid for the 102. So they could have put this spread on for absolutely almost free. Let's take a look at the math here. So this trader bought a 102 call in crude oil for $1.47 and sold two 105 calls for 70 cents. Basically, if you've ever traded crude, it's 10 cents per penny. So 147 is $1,470, and then they collected two options at 70 cents a piece, so that's $700 per, so $1,400. So your net debit is 7 cents or $70. So for $70, this trader could have gotten into, basically taken a shot in crude and said, I'm willing to spend $70 to see if it happens to go up, and if it doesn't, it's not the end of the world. And again, that trader might have used it as some sort of hedge against a short option strategy or a short future strategy or something like that. But you'll see in this example, your max profit on a trade like this is going to be the difference between the strike prices minus what you paid to get in. Well, we only paid $70 to get in. So basically our max profit is the difference between the strike prices. And in this case, remember, we bought the 102 call, which is right here, and then we sold two 105 calls. So between 102 and 105, that equates to $3,000. So this trader could have possibly, if everything went perfectly, and I mean, we all know nothing ever really goes perfectly, but if it went perfectly, you could have turned $70 into $29.30. So, again, it would have taken a decent-sized move in crude, but for $70, someone might have thought maybe it's worth a shot. Your break-even point is going to be the strike price plus whatever it is that you paid to get into the option, the net debit. So in this case, again, we paid 7 cents or $70. So our break-even point is 102.07. So in a nutshell, anything below 102.07, the trader loses money. The trader loses $70. If the market goes above 102.07, the trader essentially, it's like being long a futures contract, and the trade maxes out at 105. The easiest way to look at it is you'll notice that we've got a little triangle here, and the reason I have that is the trader basically makes money from 102.07 up to 105, and then once it reaches 105, remember we're long one 102 call, but we're short two 105s. So beyond 105, every penny that the market goes up, we are capped out on our spread basically because we're short two calls. So one of the 105s covers the risk on the short, or I'm sorry, basically covers penny for penny on the 102 call. So for instance, let's say the market gets to 105. Once it gets there, every dime that the market goes up, we're making a dime on the long call, but we're losing on the short calls. So one of those short calls just balances out our long call, and then the other short call actually eats our profits. So beyond 105, we start giving all the money that we made back from 102 to 105 back, and then we run out at approximately 108. It's actually like what, 107.93, but you get the idea. At about 108, we run out of money. And then here's the clincher. The trade was cheap to get in. It was only 70 bucks. And it, you know, it has a $3,000 profit potential, which would have been obviously fabulous on a $70 trade. But the downside is, above 108, we're now short two calls, and we've given back all the profits that were acting as our cushion. So we're basically naked one call option above this price. And it's almost like being short a future. So we're facing unlimited losses beyond 108.
Adrian is saying only at expiration. So how does expiration come into play?
Okay, that's absolutely true. All of these, that's a good point. All of these numbers are based on at expiration. At any time before expiration, I mentioned a little bit earlier, things could be different because you're talking about volatility and time decay and all those types of things. Like there's really no way to predict what the option values are going to be before expiration. So we don't know truly what our risk and our profit potential is going to be before expiration. We can only calculate it at expiration. And that's because, like I mentioned, if crude rallies to 105 tomorrow, we're probably going to be in a world of hurt because there's going to be a lot of time value left on the options. And the two 105 calls that we're short are probably going to be picking up a lot of value because, number one, the volatility is high. Number two, there's a lot of time value left. And number three, there's probably a lot of demand for call options when you see a market move like that. If it takes 3 or 4 weeks for that to happen, you're going to be sitting pretty. It's going to be a fabulous trade. So unfortunately, that's what turns a lot of people off to options is they really don't know truly with precise estimates anyway what the profit or loss is going to be until expiration. But you can get an idea of most of the time. Things kind of stay within the overall realm of expectations. It's just going to be the black swan event type of situation where things get out of hand with your short options. But that's something, unfortunately, that you'll learn and get familiar with experience. It's not something you could read in a book or learn in a slideshow. Which is why we need to let you know about ratio risk management. And a 1/2 ratio spread, it can be challenging in volatile markets because this is kind of exactly what we were just talking about. The extrinsic value or the implied volatility of the two short options can engulf the profits on the long option. And this, again, is at any time before expiration. At expiration, you can calculate with certainty what the values are going to be and things like that. But before expiration, volatility and, again, human emotion come into play. So things can be skiwampus for a little bit.
And Carly, on the last example, are you talking about weekly or monthly options? Ron is asking that question.
Well, you could do it with the particular example we used are monthly options. We typically stick to the monthlies. The same overall, strategy can be used with the weeklies, but with the weeklies you're always talking about quite a bit less premium and getting quite a bit closer to the market. So as long as you're comfortable with that, you could use the weeklies, but we tend to use monthlies.
Okay, thanks.
A 1/2 ratio, right, should not be used if you're expecting a really large move. If the market's quiet and you think volatility is going to explode, this is not the strategy to use. There's other strategies that you could use in that type of situation, but this one is not the one. All right, let's talk about iron butterflies. An iron butterfly is basically a 1/2 ratio, right? But it has limited risk because we're buying an extra option to limit the exposure above the market. It basically creates a 1/2 ratio, right, into a limited risk debit spread. Now, because we're buying an option to protect ourselves from an unlimited risk, that also means that we're spending more money out of our pocket, and that shrinks the profit zone because basically it's the opportunity cost of capping the risk. And if you thought a 1/2 ratio was complicated to squeeze a profit out before expiration, a butterfly can be even a little more difficult because we're talking 4 legs to a spread. We're going to be buying 2 options and selling 2 options. Now, I'm not saying you shouldn't do it. It can be a great trade, but you just want to know getting in that it's a commitment. It's not something that you're going to be able to trade in and out of in a couple days. This is, your time horizon is going to be at least a couple weeks, probably more like a month or so. There's obviously 2 types of iron butterflies. You can do it with calls or you can do it with puts. The guys that I talk to on the trading floor, they call them call flies and put flies, and I'm not sure that's necessarily a technical term, but that's just, if you say call fly to someone, they'll probably know what you're talking about, at least in the world of commodities. The idea of a call fly is to buy a close to the money call, and then we're going to sell 2 out of the money calls at the same strike price. Again, this is just a 1/2 ratio spread, but then we're going to add the 4th option, and that is to buy 1 equidistant. When I say equidistant, it's going to be the same distance between the long call and the 2 short calls, and this will absolutely eliminate any risk in addition to what you pay for it. So what happens is it becomes a bullish trade. It's a range trade with limited risk as long as you hold it intact. Now, I've worked with traders that didn't understand that once you start peeling the spread apart, that changes the risk parameters. And as long as you have your long 2 options for every 2 you're short of the same type, your risk is capped. But if you start lifting legs and all of a sudden you're short more than you're long, your risk is unlimited. A call fly is open for adjustments. You don't have to keep it intact. In fact, I mean, in a lot of cases, it might be a good idea to peel it off. For example, if you put a call fly on and the market rallies, you might look to take a profit on your long call and hang on to the short calls, or at least take a profit on the long call that's making the money, and then you can leave the 1 long call up above just as insurance in case something goes horribly wrong. So you don't have to leave them intact, but you just have to understand that your risk changes as you're playing with the trade. And a put fly is the same thing. You're buying close to the money put, you're selling 2 out of the money puts, and then you're also buying a 4th put to basically cap your risk on the downside. And we'll take a look at what this might look like in an actual trading scenario. Okay. This is actually kind of an add-on to the exact same trade we were just looking at. If you recall, we bought the 102 call, we sold 2 105 calls, and our cost was $70. Well, we're going to cap our risk by buying the additional 108 call for 35 cents, or oops, that should be $350, not $35. So our total cash outlay, instead of being $70, it's now $420. But for the extra $350 we paid, we now have limited risk. So maybe, it might be worth it to you, it might be not be worth it to you, but that's something that you as a trader decide, and you either buy the protection or you don't. So now this changes the parameter of the trade a little bit. The max profit is now $25.80, so the max profit is dropped by exactly $350, and that's because we paid an extra $350 to get into the trade because we bought the additional insurance. And what it also does is it tightens our profit zone. And this is because once the market gets above 102, before we only had to make up 70 cents. The market only had to get to 102.07 for us to start making money intrinsically or at expiration. But now we have to make up $420, which is 42 cents. So the break-even point now becomes 102.42. And not only that, but it also cuts off where we, or actually I should say, we begin losing money faster because our profits are a little bit smaller on the way up, so we have a little less to give back. And you'll notice on the previous example, we had, if you recall, we had unlimited risk up here. But in this example, with the iron butterfly, because we bought the protection, we have limited risk. So our risk is limited to 420 on both sides of the market. And we're looking for a sweet spot of around 105. Anywhere between about 102.40 and like 107.60, I guess. We make something, so that's still not too bad. But I'm not sure I would spend, this is just my opinion, I mean, you know, everybody's different. I'm not sure I would spend $420 on this trade. For $70, it seemed like it was, you know, worth a shot. For $420, I'm not so sure, because if you look at it, the market's down here trading around 98, 99-ish. It would take a pretty big move to get up to 105. And you know, I'm not sure the odds really aren't there, but this is just an example, and so you get an idea of the math.
AZ is asking the difference between this, what you know, you're saying iron butterfly and just a regular butterfly.
Right.
He says, you know, irons are selling both calls and puts, well, same strike. Yes.
You know, honestly, the crazy thing about options is it really depends on who you're talking to and what part of the country you're from. This is the way that I learned iron butterfly. If you talk to someone like from New York, they might have a different idea. I mean, it's all, you know, I'm not sure that there's really one language when it comes to option trading. I guess that's the best way to put it. This is the way that this is what I refer to as an iron butterfly, which is basically all of the same option types. So we're buying a call, selling two calls, and then buying a call above. Some traders just refer to it as a butterfly. So I mean, it really just depends on who you're talking to. Hopefully, right, you know, you just understand what the strategy is, and you can, you know, theoretically you can name it anything you want. I actually talked to a trader that named, he had crazy names. Like instead of using traditional or at least close to traditional names for his spreads, he named them like R2. I mean, so you could call them whatever you want, and most people do. If you like different brokers that I talk to on the floor, they'll have slightly different variations of names to different spreads. So the idea is hopefully if you're ever talking to someone and you make sure you clarify with them that you're talking about the same thing, because you will find different books and different traders all have slightly different interpretations. Okay, let's talk about debit spreads. Now, debit spreads are probably the most, well, a debit spread can mean anything really. A debit spread is just a spread that you pay more money for the long options than you do for the short options, and it could be any combination of any type of spread that you can think of. But the most common, and what most people are talking to, when you say debit spreads, most people are typically referring to a bull call spread and a bear put spread, and these are just really simple option spreads. A bull call spread is where you buy a close to the money call and you sell an out of the money call. Now, you'll notice that a lot of these have similarities. For example, this really is nothing more than the ratio, right? But instead of selling two calls, we're only selling one. So it's really the same idea. But we're buying a call and then we're selling an out of the money call to pay for it. Now, a spread like this has limited risk because you're buying one and you're selling one. So there's no naked call or anything to deal with. Now, we'll talk about a little later. You could take a bull call spread like this and you could finance it, because when you do a bull call spread or a bear put spread, it's going to cost you money because you're always buying a close to the money option and then selling an out of the money option, and we all know that options that are closer to the market are more expensive than options that are further out. So it's always going to be a debit, but you can pay for that debit by selling an extra call up above the spread or selling a put underneath. So there's lots of things you can do, but this is just the basic debit spread that a lot of people are comfortable with because it has limited risk. And it is a little cheaper to do it this way than just simply buying the option outright. So a bull call spread is bullish. The cost is mitigated, but it's still pretty expensive. And it has a pretty distant break-even point. So remember, anytime you're buying an option, the market has to go far enough for you to actually recoup what you paid for the option before you start making money. So if you're doing a bull call spread, which are a little pricey to get into, the market has to move that much further for you to make money. But again, you can reduce your cost by selling more options, and we'll talk a little bit about that. A bear put spread is basically you're buying it close to the money put, you're selling it out of the money put. And again, there's limited risk. The cost is mitigated, but it's a little bit expensive. And there's limited reward. Anytime that you're buying and selling an option of the same type, and when I say type, again, calls or puts, you're capping your risk, or well, you're capping your risk, and you're, in most cases, limiting your reward. In this case, we are absolutely limiting our reward. If you buy a bull call spread and the market goes higher, you stand to make some money, assuming that it goes high enough. But once it gets to your short option strike price, your short call strike price, your profit potential is capped. The market can go as high as it wants, and you're not going to benefit from it. And that's not such a bad thing. It's just something that you need to understand going in, because it can be frustrating. You know, a lot of traders just psychologically they think of that as lost money, and that obviously it's not necessarily true. They should be celebrating the fact that they were right and they made money, but we're human and we don't think like that, so we always look at it as, well, I could have made this much if I wouldn't have had that short call there, or I could have done this, and so that's unfortunately just the nature of trading. A bull call spread or a bear put spread are probably best used as a counter trend strategy. However, as we mentioned, it does involve a large out-of-pocket expense. It creates a pretty distant break-even point in many cases, and maybe not the best odds of success when it comes to option spreads, but one thing to keep in mind is if you put on a debit spread, let's say that you put on a bull call spread in a market that's trading near a low, like the market's a little oversold, you think it's going to turn the corner, but you're not willing to do a ratio, right? Because remember, if you're selling options for cheap and the market whipsaws back, you could get in trouble. What you could do is do something like this, a bull call spread, with the intention of selling the second call after the market turns the corner. That way you can get a little more premium for the call, and it won't get in your way, hopefully.
Ron is asking the question, do you use the same strategy every month, or do you change the strategy throughout the year?
As far as the recommendations that we provide to our clients, we rarely will repeat the same thing every month. In fact, we're kind of doing different things every month. We try to let the markets, I mean, nobody's perfect and no one has a crystal ball, but what we try to do is to let the markets tell us where the opportunities are. So, for example, you know, we tend to favor the idea of selling strangles in crude oil, but sometimes months will go by that we don't do anything in crude oil because the volatility is too low, or, you know, for whatever, you know, maybe we think there's just not enough premium, or whatever the case is. So we actually are fishing different markets and different strategies all the time. We don't really stick to the same thing repetitively.
And don't you trade a lot of softs? I mean, I don't trade softs. I never have, but my understanding would be that there's definitely going to be, you know, drastic swings throughout the year due to weather and such.
Right. We have clients that trade the softs. Me personally, I'm not a huge fan of the softs because there's a liquidity problem sometimes, but we do put out some recommendations here and there. Like, for example, if you look at a sugar chart, sugar is really quiet, and sugar doesn't stay quiet for long. So in a market like that, we look at it and say, well, sugar's quiet, the volatility's low, the options are cheap, so we're looking at options, you know, in October and further, and just buying basically lottery tickets. You know, if the volatility explodes, great, we're there. If it doesn't, we're out, you know, a few $100, and it's not the end of the world. So we're doing those types of things in sugar just because it's super quiet. But the softs are a tough market. They're, you know, liquidity's not there. I don't know if you followed cotton at all, but cotton in the last couple of years have been, it's kind of known as the widow maker. Went from 70 cents to $2, back to 70 cents for really no legitimate reason. So we don't do a whole lot in the softs, but every once in a while you can find some good stuff going on there.
Okay, thanks.
All right, let's take a look at, this is actually soybeans, and we're looking at a bull call spread in soybeans. And again, this isn't a recommendation or anything. This is just so you understand how the trade works and the math and all that sort of thing. Anyway, this particular idea is to buy a 440 call, which is pretty expensive. I mean, you can see it's approximately 20 cents, and 20 cents in soybeans is equivalent to $1,000. So I don't know about you, but for me, spending $1,000 on an option that probably will expire worthless or has a pretty good shot of expiring worthless anyway, to me that just seems a little bit crazy. But you can sell a 1480 call for 10 cents and at least cut the cost of the trade in half. So instead of spending $1,000 and risking $1,000, we can risk $500, which is a little bit more reasonable to me. Now, the opportunity cost of limiting our risk to $500 is that we're capping our potential. Anything above 1480 doesn't matter to us. I mean, we made our money, that's it. We don't benefit from anything above 1480. But, to shift your odds of success in the right direction, I think it's probably worth it. And to cut your risk in half, it's probably worth it. Let's take a look at a chart here. So I just rounded the numbers for simplicity, just because I'm not a math genius. But we bought the 1440 call for 20 cents. We sold the 1480 call for 10 cents. So we paid 10 cents for the spread, which is $500 in soybeans. Okay. Now a trade like this, again, it's the profit potential is capped between the distance between the strike prices. Because remember, once it gets up to the 1480 call, we're long a call, but we're also short a call, and it basically balances each other out. For every penny we're making on the long call, we're losing on the short call. So above 1480, it does us no good. But if it's at 1480 or above, we make $1,500, and that's not so bad on a $500 trade. And remember, our risk is limited to $500. No matter what happens, if soybeans go to zero, we still only lose $500. So I mean, you could kind of see the appeal in something like this. The only way for this trade to make money, though, is if the market is above our break-even point at expiration, which is $14.50, and we get that by we're taking the strike price of $14.40. Remember, we're buying the $14.40 call. We paid 10 cents for the spread, so we have to make up that 10 cents before we actually start seeing any profit at expiration. And once we get to that point, about approximately $14.50, we start making money, and then we max out at $14.80. Now, to me, I mean, $500 for a trade to possibly make $1,500, that's not that bad. I mean, I've seen worse, but what you may want to consider doing is actually reducing your costs even more. And you can finance your debit spreads by selling options around it. And that might mean selling a put underneath the market, or that might mean selling a call above the market. But the idea is you can sell more premium. You don't have to do, the textbook bull call spread. You can make it your own by collecting more premium and doing that sort of thing. So again, a bull call spread trader could sell an additional call with a distant strike price to reduce the cost of the primary position even more. You might hear this called the Christmas tree, and again, the crazy world of option trading, everybody has a different name for every type of strategy, but I've always known this as a Christmas tree. And it's basically a version of the ratio spread, but the 1-by-2 ratio spread, if you remember, the two options we're selling are the same strike price. In this situation, a Christmas tree is basically a bull call spread with an extra short call above the market. So we're selling two calls, but we're selling two calls at different strike prices. The goal of selling the premium is to increase the odds of success by accomplishing two things. We're basically shifting the break-even point closer to the money because we're paying less for the spread. We're lowering the out-of-pocket expense of the trade. And don't forget the way that the trade works is we make money, we start making money at the long call strike price, and then we max out at the short call strike price. But if we pay less to get into this trade, our break-even point is lower, our cost is lower. The benefits are not without additional risk, though. By swapping the lower cost and the better odds of success, we're taking on unlimited risk for being too right. And we'll show you a chart on what this might look like in just a second. Actually, I take that back. I'm not sure I do have a chart. Yes, I do. All right, so anyway, now with this said, I keep nonchalantly mentioning that you sell more premium to pay for the option that you're selling. I'm sorry, the option that you're buying. But you really, really want to keep in mind, when you're selling premium to pay for a debit spread or for any option, you're taking on risk. So you want to make sure that you're carefully choosing your risk point. You can't control the market, but you can control your risk points. When you're selling options to finance a primary long option or a debit spread, you want to make sure you're placing the strike of the short option, which is essentially where you're placing your unlimited risk, beyond support and resistance areas. You don't want to just blindly sell options and say, well, if I sell this option, I'll collect 10 cents and make it a free trade, and free sounds good, right? But you want to make sure you're really putting that in a place that you can be comfortable with, because after all, that additional option is bringing you unlimited risk.
AZ is asking, what about selling an at-the-money put with a stop to pay for the faded decay?
You could do something like that. It basically turns it into you're short a put, long a call. It's almost like a synthetic futures contract. It's almost like being long a futures contract. Well, similar. Actually, it is. You could do that. It's quite a bit more aggressive than something like this. But again, every trader is different, and if that's your cup of tea, that you could certainly do that. The one thing is, you can't really place a stop on an option. You could place a stop on the futures price. So like if you sold an at-the-money put, you couldn't put a stop on the put price, but you could say, okay, if the futures went down to whatever, 1380, I'll sell a future just to cover my short put. So you could do something like that. But me personally, I've never had a whole lot of luck trying to trade at-the-money options against futures contracts, just because maybe I'm unlucky or maybe I just have horrible timing. But you seem to always get stopped out, and then you try to get back in because you have unlimited risk, and then you get stopped out again. And so to me, it's just a chop fest. But again, I'm sure there's people out there that have much better timing than I do. I don't know. So it's an idea. And again, that's good that you're thinking of things like that, because you're understanding that there's no right and wrong, and there's no black and white. It's, you need to be creative and just find your own risk-reward profile. Okay, here's what something like that might look like if you did sell the additional 1510 call for 8.5 cents. So remember, our trade originally was it had a cost of 10 cents, which was $500. Well, our new cost is only $0.015, which is like $75 in soybeans. So for $75, we could have basically put a spread on that maybe could make $19.25. Now that seems like a pretty good bet to me. Again, I'm not recommending this trade, but I'm saying a trade like that where you're spending $75 to maybe make $2,000, I think it makes sense to me. But again, you have to make sure that you're putting the strike price of your short option above resistance areas, because trust me, you don't ever want that option to become in the money, and if it does, it makes for some sleepless nights. So you want to really try to avoid that sort of thing, or adjust before it happens. Of course, you never know. You don't know what the markets are going to bring tomorrow, and sometimes beans can move fast. But the idea is you want to trade logically, not emotionally, and the way to do that is to keep yourself out of the fire as much as possible. Now here's the payout on a trade like that. If you recall, our original profit potential was $1,500 or 30 cents. Well, because we're collecting an extra 8.5 cents, our profit potential is now 1925. That's a pretty big difference. And what that does is it shifts our break-even point lower. So it's more likely that we'll make money on the trade, or I should say it's more likely that the market will reach our break-even point because it's a lower price. And on this new Christmas tree, or whatever you want to call it, our break-even is basically, remember the strike price is 1440, so if the market gets to 1441 and a half, we start making money intrinsically. We max out at 1480, and from 1480 to 1510, which is where our extra short call is, it really, it's indifferent to us. We don't care if the market's up, down, or sideways. If it's between 1480 and 1510, we make our money. We make our 1925. If the market goes above 1510, that's where we start giving our money back. And we eventually are going to lose, we'll eventually give it all back and get into a point where we're facing unlimited risk, and obviously none of us want to be there, but that's what could happen, and we have to keep that in mind. So again, our opportunity cost of getting a lower break-even, less out-of-pocket expense, was adding additional risk on the upside. So you have to just decide, is it worth it to you? Can you sleep better at night? But more often than not, I would say the odds are probably in your favor for a trade like this than it would be just an outright bull call spread. Now, just as a side note, you could have, instead of selling a 1510 call, you could have made this trade even more aggressive by selling a put. And you might have said, look, there's some support down here. I'll sell a 1360 put to finance my trade. And that way, you're swapping your risk from the upside to the downside. Again, be creative and make the options do what you need them to do. You can construct just about any type of strategy or risk reward with options.
A couple of quick questions. TJ is asking, are pure option plays better than combinations with the underlying?
I'm sorry, can you repeat that, please?
He says, are pure option plays better than combinations with the underlying? I'm not sure I understand. TJ, maybe you can clarify? Or do you understand, Carley?
I think so. I think what he's talking about is trading, like instead of buying a call and selling premium around it, possibly just going along a futures contract and then maybe selling some calls against it. It really just depends on, again, how aggressive you want to get. I tend to like the idea of, if you're going to play the futures contract outright, I like the idea of using options to hedge it or to limit the risk as opposed to just placing stops, because we all know when you're trading futures, for some reason stops tend to get hit just before it goes the way you want it to go. So I don't necessarily know that this is a better way to do it. It's probably a lower volatility way to do it, but I'm not sure better is the right word.
Okay. Kevin is asking. Kevin's asking, it seems like a visual tool like option view would be helpful if you're going to do more than a basic debit spread, and he wants to know if you offer anything like that.
We do have access to those types of software. We have Trade Navigators, Option Navigator. Option View is kind of I don't know if it links directly into any of the platforms that we offer, but a lot of our clients do use Option View. So yeah, it really just depends on how mathematical you want to get. I personally do not use any software like that. The platform that I use is QST. It's Quick Screen Trading. And it doesn't necessarily chart the Greeks and all those types of mathematical formulas, but what it does for me is it charts the option price. And for me, that just gives me a lot more insight than maybe the option analytics software does. But again, it's just because there's more than one way to skin a cat. You just have to find what works for you. But I like QST because, like I said, it tracks the option price, so I can see, okay, this call option was going for 50 cents yesterday, now it's 70 cents today, and then maybe tomorrow it'll be 90 cents, and I'll say, hey, it's almost doubled in a couple days. I might start looking at that, or at least put it on the radar to be a candidate to sell or something like that. So I mean, you want to be, I would say my advice to you is, you want to be, I'm not saying don't use option analytics software because it can be a great tool, but you want to be careful not getting too, making it more complicated than it needs to be, because the markets don't move on mathematical equations, or they move on emotion. And so you just, again, you have to keep in mind the software might be spitting out specific odds of success today, but tomorrow it could be a completely different ballgame. So you don't want to get too caught up in believing what the software tells you. You have to keep in mind that it's constantly evolving and things are constantly changing.
Right. I see a couple people asking about the platform. So it's QST as in quick screen trading, right?
Right. Quick screen trading. We offer it to our clients. It is a platform that I don't know the specific pricing. You're going to want to have to contact them about that, but I can give you ballparks. Like the cheapest version, it runs about $50 a month, and the most expensive, which is what I use, is about $300 a month. But I would venture to say most traders could get away with the $50 version, most retail traders. And to me, it's probably my opinion, and I'm not a software salesman. I don't get anything for this, but I think QST is probably about the best overall well-rounded product out there for trading futures and options on futures. So that's my opinion. I mean, you can pull up an option, like an option chain, and it'll show all the option prices, but it'll also show your position on the same window and your futures position, and it'll give you like a net delta. So I mean, it's pretty cool stuff.
And people that want more information, should they contact you, or I see some more questions on it?
Yeah, if they send me an email, I'll send it. We have some information on our website as well on it. Okay. But if they send me an email, I'll get them just a little bit of information. They can sign up for a demo and all that kind of stuff.
Okay.
Okay.
Your phone's ringing off the hook.
I know. I'm sorry. You'd think that they would wait, but anyways. All right. Did we have any other questions, or?
That's it for right now. Actually, hang on. Kevin is asking what kind of option commission. Right, yep. Sorry, Kevin's asking what kind of option commission are you charging for futures options?
Well, really, I mean, we base everything based on volume and account size and all that sort of thing. But I'll give you ballparks just to give you an idea. We charge. Most of our clients are trading short options, which if you've ever shopped around for a place to sell options, a lot of brokerage firms will tell you flat out no, or they'll charge you extra margin, or they'll charge you more in commission than you should probably pay. But we specialize in that sort of thing. So with that in mind, I mean, we work pretty hard to get our clients the lowest margin rates and the fairest treatment from risk managers and things like that. Most of our online traders are paying less than $10 round turn. It's somewhere 10 to 15 for smaller accounts, less than $10 for the bigger accounts. But I mean, that just gives you an idea. Every client's different. The idea is we want to give people the best shot at making money, but of course we have to cover our costs and all those types of things. At that rate, we put out option trading recommendations and guidance and things like that. If you're looking for a full service broker, we do that as well. Full service runs anywhere from, depending on how much help you need or don't need, could be as high as $30 and as low as $10. So, I mean, it just depends. But if you give me, if you email me with your parameters, I'll give you a quote. I can give you a precise quote.
Okay. One more question right now. AZ is asking, do wide bid-ask spreads factor into your trade selection?
Oh, yes, definitely. There's a lot of commodity markets that really probably shouldn't be touched when it comes to option trading, and that's because of the wide bid-ask spreads. One off the top of my head that I can think of is copper. For some reason, a lot of beginning traders want to trade copper options, and I'm telling you, it is a no-win situation. I've never seen anyone make money on copper, and not because for any other reason other than the market is just it's just illiquid. I mean, you'll see bid-ask spreads of like 2 or 3 cents. Well, a cent in copper is $250, so you can see how fast it would add up. Just the getting in and out will eat you alive. So there's definitely markets that we avoid because of that. We tend to stick to the liquid markets, so like the treasury bonds, even the S&P, even the NASDAQ, crude oil, euro, the grains. So we'll venture into the others every now and then, but those are kind of the main main markets we try to stick to. So as I kind of mentioned before in the last slide, I just wanted to kind of reiterate this. Rather than selling an additional call for the Christmas tree, we could have sold a put to finance the primary position of the bull call spread. And this basically just shifts the risk from the upside to the downside. This is a little more aggressive, and it requires a little more margin than the version that we charted out. But it's just to keep, get your juices flowing and to show you that there are lots of possibilities. And in conclusion, remember I said in the beginning, if you walk away with anything, I want it to be that you understand that there are no limits or no limits to the possibilities. And so I'm going to say it even yet one more time. There are no limits to the possibilities in option trading. If you're creative, you can construct a strategy that fits any risk-reward profile, and that's, from the most aggressive to the most conservative. In my opinion, you're better off, or you're better served trying to be a net seller of options in most circumstances, but every circumstance is different. Again, I mentioned, if you look for quiet markets like sugar, which I think is pretty quiet. Maybe in a market like that, you might consider being an option buyer and not selling premium because the options are cheap. So why would you want to sell options in a cheap market? You want to be a buyer in those instances, but you want to, you have to be aware of the situation and aware of your surroundings. And don't just blindly sell options because eventually that'll come back to haunt you. You want to make sure that your risk levels are at appropriate levels. If you're selling calls, make sure it's above resistance. If you're selling puts, it's below support. Give yourself a chance. I want to thank you all for attending. If you have any questions at all, you can either ask me now or if you think of them later, give me a call or send me an email.
Thanks, Carly. And there are a couple of questions, so we can see if we can get these answered real fast. Dan is asking, what should we expect from a trial? Do you provide trade recommendations to follow along? Do you have like paper trade accounts, et cetera? So this is for somebody that wants to open an account with you.
Okay. Yeah, if you sign up for a trial of our client newsletters on the website, the DeCarley Perspective or the Financial Futures Report, what we'll do is we'll give you I think Tracy gives about 5 or 6 weeks, but you'll basically follow us along and you'll be getting all the emails that our clients get. So daily commentary that just kind of talks about what happened real quick today and that sort of thing, but you're also going to receive option trading ideas. You'll get the entry, the exit, any adjustments, and we'll tell you the exact strike prices, the exact premium that we're paying or selling, and all those types of things. So hopefully you can follow right along. And feel free to ask questions if you don't understand something or you need more clarification. We try to, when we give our clients a recommendation, you have to keep in mind the markets move fast, and sometimes we're frantically typing and the markets are moving, so it gets kind of chaotic. We try to give a lot of information, like why we like a trade. Are we looking at seasonals? Are we looking at the chart? Are we, watching sentiment on CNBC or whatever the case is? So we try to give the background and the reasoning as to why we're choosing strike prices and things like that. But sometimes we're just so overwhelmed and trying to get something out real quickly that we don't have time to put it all in. So feel free to send us an email for extra clarification, and we'll be more than happy to give you an idea of what we were doing and why.
Okay. Tom is asking for clarification that you offer all the E-minis on CME, and also he's asking about the safety of segregated accounts. Let's back up for just a second.
Sure.
Options are regulated. So is it who's overseeing it besides the CFTC? Is it the NFA still?
It is. Yeah. No. These are great questions. Okay. We offer really any futures exchange worldwide. We offer those to our clients. So you could trade any futures market or options on futures that's listed. Now, with that said, you're exactly right. The futures and options industry, or when I say options, I'm referring to options on futures because that's what I deal with, and I'm not talking about options on stocks. That's a whole different ballgame. But with what we deal with, which is futures and options on futures, it's regulated by the National Futures Association and the CFTC, the Commodity Futures Trading Commission, and it is a very highly regulated industry. I know that with everything that went on last year with MF Global and PFG, you might not feel that way, and trust me, you know, us as industry participants, we had a really rough year trying to swallow all that as well. I can tell you that since PFG and since MF Global went down, the industry, well, specifically the NFA and the CFTC, have taken pretty dramatic strides to prevent that from ever happening in the future. As of now, they're talking about deposit insurance on commodity accounts, but it's not something that's been approved or set in stone, but it is at least an idea, which would be fabulous for our industry, because it would, you know, any sort of lingering doubt that might be out there would be eliminated with deposit insurance. But what they've done as of now is prior to PFG, which I know this is hard to believe, but prior to PFG, the auditing was all done on paper. So they were verifying bank account values by paper, and in today's internet world, to me, it just seems crazy that that was happening. But unfortunately, it took an event like that to change the bureaucracy of the process, and now they actually have electronic access to brokerage bank accounts, so they can verify funds in real time. And in my opinion, that almost, I don't want to say eliminates, but that greatly reduces the chance of something like that ever happening. So I'm going to assume that going forward, and trust me, my business really suffered last year with the PFG debacle, and so, you know, I'm putting my business and myself on the line as going forward in saying that I feel pretty good about the industry and the safeguarding of funds. Everything, as always, I mean, as it worked for 100 years, it just happened that for whatever reason, you know, we had these two kind of off-the-wall scenarios last year, but going forward, brokerage funds and client funds are segregated as they always have been, but at least now there's electronic verification, and so, you know, I'm willing to accept the fact that there's a lot of mistakes made in the past, and hopefully they won't be made in the future.
Right. Well, I think most of those mistakes are from the regulatory bodies, not from. I mean, there's always going to be bad people in the world. So what you need is, you know, and like you said, deposit insurance or some type of insurance is really what I think everybody's hoping for.
I think it would be great. Yeah. Hopefully they can get something like that together.
Yeah. I think actually that they will. Okay.
I agree.
Ron is asking, what if you own an underlying stock and you sell a call? Okay.
Well, again, like, we don't deal in stocks, but I mean, you can do the same idea with futures in that basically it's covered call strategy. And I would kind of add to that, in the futures market, because there's leverage in futures, you're probably going to want to sell 2 calls for every futures contract you're long, but that's a whole different class. But basically, if you're long one future and short one call, you really don't have any risk on the upside. Your risk is on the downside. If the market drops sharply, the short call will be making money, and that's going to hedge the risk on your long future or long stock, whatever it is. But it's not an absolute hedge. I mean, at some point you run out of money, or you run out of cushion because you only collected, you know, X number of dollars for your call, and once that hedge is gone, you're naked on the downside on your stock or your future, whatever it is. And that can be I like that type of strategy. Again, if you're doing it in the futures, I would probably recommend selling 2 calls for every future. But I mean, it's basically, you know, a way to hedge your position. So.
Dory is asking, can you ask the advantage of options futures compared with stock options? So, you know, we just kind of touched on that. I mean, leverage carries over, but why do you personally trade futures options instead of equities?
Well, I mean, I just happen to be a lot more familiar with commodities, but so I'm sure if you talk to a stockbroker, he's going to say stock options are better, and I'm going to say commodity options are better. That's just how it is. But I can tell you there are definitely some reasons that options on futures are a lot better, just what I can see. The margins, if you're trading stock options, a lot of brokerage firms, if you want to sell stock options, they're I don't know if everyone asks, but I would say most of them ask for a pretty sizable account. Some that I've talked to want $100,000 in an account just for you to be able to sell stock options. In a commodity, and also with stock options, to get portfolio margining, I think the last I had heard most brokerage firms want it like $75,000 to $100,000 to get portfolio margining.
Right.
But you can get that in a commodity account with $5,000 or less. All commodity accounts are portfolio margin. So even if you have like $3,000 in your account, you get portfolio margin.
Okay.
And also, as an option seller, I know, just talking about the S&P, like if you're selling options in the SPY or SPX or whatever it is on the stock side of things, it takes a lot of margin to collect a little bit of premium. In futures, you can collect a lot of premium with a little bit of margin. Like, to give you an idea, a trade, we do a lot of crude oil strangles, or at least we put a lot of recommendations out. They're usually, the strike prices are usually about $20 to $25 apart. We usually collect somewhere between $1,000 to $1,500 per strangle, and the margin on that is usually, again, it fluctuates, but usually around anywhere from $1,700 to $2,000. So it's very possible that we're collecting $1,400 on a $2,000 margin requirement. You can't do that in stocks.
Right. So I think everybody knows that I don't know very much about options, so this might be a very stupid question, but if you're trading something like Apple, which is a very expensive stock, even though it's got pretty good volatility, don't you have to? Isn't the margin, is it still considered span margin when it's an equity? Is it only for futures? But isn't it very, very high? You got to put a lot of money behind it in order to get any kind of size.
Right. That's my understanding. In stock, again, I'm not by any means, I'm not an expert on stock option trading, but from everyone that I've talked to, and I've dabbled here and there in my accounts, and it seems to be, yes, you have to put like a ridiculous amount of margin up to sell a little bit of premium. And on the future side of things, it's just not like that. I've had clients open with $2,000 or $3,000 accounts and sell options, and I can guarantee you wouldn't be able to do that in a stock account. One other thing too, while I'm thinking about it, there's also preferable tax treatment in a futures account than there is a stock account. So if you're doing option selling on futures or option trading or whatever it is, or even futures outright, at the end of the year you receive a 1099 with one single number. It's a profit or loss, and you basically report that one number to the IRS. You don't have to report each individual transaction. And the number that you do report is taxed at a 40-60 blend, so you're only paying 40% long-term rates and 60% short-term. So right. It's a lot favorable tax-wise than it is in the stock side.
AZ is asking, if you're trying to construct a synthetic future position, is it better to buy and sell a call put at the money, or buy 70 delta for the long and sell at the money for the short?
If you wanted a true synthetic, you'd want to go at the money with both options. I would say, I don't know if one's better than the other. It's really just how aggressive you want to get or how much risk you want to take. I would say if you're going to do a synthetic like that, though, you might as well just go for the gusto and do it at the money. But again, each situation's different, so I'm not sure that there's really a right or wrong there. Just okay. Whatever fits your profile.
Stephen is asking about backwardation, and we can add in contango like for oil. How does that affect it? He's talking about primarily trading the VIX, like long-term charts of the VIX. How does that come into play with options?
To be honest, we haven't really done much with the VIX. The VIX is kind of a weird market. It is a futures market, and it does have options against it, but it's traded on the CBOE, which is a stock exchange. So even though our clients do have access to it and we have access to it, but because it's just such a strange animal, we tend to just trade S&P options instead of VIX options. It's basically it's very similar. You know what I mean?
What about
you're buying volatility instead of buying VIX calls? You're buying S&P puts.
What about if the same were true for oil, which has the same problem? Do you ever see, like, if you're outright on a long futures position on oil towards the end of the monthly expiration, some really weird things can happen that it's
Right.
all from the contango that doesn't have anything to do
Right.
with the actual price of the next
Right.
front month. How does that come into play with options?
Well, that's a good question. We try not to let things like that impact our trades if at all possible. Like, for example, let's just say that we sell a crude oil strangle, or we recommend to sell a crude oil strangle. We would very rarely recommend holding it all the way to expiration, because you start getting those types of crazy things going on. Like, our idea is you really, I mean, it's hard enough to trade, but if you start talking about things that are coming into play, like expirations and all these types of things that have absolutely nothing to do with fundamentals or technicals, it's just, completely out of left field type of market action, we try to avoid that. So as an option seller or an option trader, whatever it is, you really want to try to work your way out of the options, within a couple weeks of expiration. Or if you're holding a ratio spread or something that you don't see a lot of profit going into, until you get closer to expiration, you really don't want to hold it to the last day, even though it seems like a lot of times it'll seem like a good idea, because you think, well, I'm losing, the theta's working for me, I'm losing premium on my short options and the market's going the right way. But I mean, anyone that has traded commodities long enough will tell you, never hold options into the last couple of days of expiration, because crazy things happen. Anyone watching soybeans on Friday will tell you, beans were, they rallied 20, 30 cents a day for 3 days, and then on option expiration, they rallied 20 cents and then ended up dropping 20 cents all within, an hour. So you just never know, and you don't want to leave your trading up to random circumstances like that.
We're getting into some more generalized broker questions, but Tom is asking if you have the ability to open a brokerage account using a SIPC, like basically using an existing SIPC account and then having that account, be like a backstop or something for margin. I mean, there's no way to do that, right? I mean, you have to,
Yeah,
the money has to be
not
in the segregated account. I don't know of anybody that
right.
would allow otherwise.
Right. No, there's no way to do that, unfortunately, because that'd be nice.
That would be a way around getting your insurance.
Right, exactly. So unfortunately we can't do that, but I'm confident that we'll get some sort of deposit insurance for commodity accounts. I think it'll take a little bit of time, though.
Yeah, I think so too. I've heard whispering, so I hope it's true.
Yeah.
AZ is asking if there's an optimal delta for constructing a synthetic future position.
For a synthetic future, there's, I mean, ideally, if you really wanted a perfect synthetic, you would use a delta of 50 on both your options. So you're basically talking an at-the-money position on both sides. So it ends up being, balancing each other out. But again, it comes down to how, anytime you're dealing with deltas, there's not a right or wrong answer. It's how aggressive you want to be. If you want to be very aggressive, you want a higher delta. If you want to be a little more conservative, you go with a lower delta. So you just have to kind of feel that out on your own. If you're kind of new to commodities and futures, I would say always go with the lower delta in the beginning, so that you can kind of build up your tolerance, because these markets move quick, and when you add leverage to it, it can be kind of a frightening situation at times. So I always tell people it's easier to get more aggressive as you go than to get, if you're too aggressive in the beginning and you happen to be in the wrong place at the wrong time, you could ruin your trading career before you even start. So.
Right. All right, a couple more questions and then we'll stop.
Okay.
Dan is asking, in addition to your book, do you have any recommendations for other books? He mentions Nattenberg and Macmillan. Do you have any recommendations?
For option books?
Yeah.
Not off the top of my head, not really. I mean, I think those are both two great books. The one thing well, actually, there is one book by Jeff Ogden that's pretty good. I think it's called Volatility Edge, I believe. You just have to keep in mind, most of the books written on options are for stock traders, and it's true. An option is not, like a call's a call, a put's a put, but there's definitely some intricacies on the futures side of things that are a little bit different, so you just want to make sure you understand as you're reading books. You're probably reading about stock options, so if you do decide to venture into futures, you understand things might be a little bit different, and hopefully your broker can kind of help you out with that sort of thing.
Okay.
But I think, yeah, Volatility Edge by Jeff Ogden's pretty good.
Dory is asking, are the spreads much larger due to less volume on commodity options?
They can be. It just depends on the market. Like if you're looking at treasuries or even the S&P, the spreads are really tight. I mean, you're talking one tick. If you start looking at softs or the meats, they get a little bit wider. So what I tell people is you want to trade the markets that have wider bid-ask spreads, you want to trade them a little sparingly. I'm not saying don't trade them if there's a good opportunity there, or maybe once or twice a year there might be really something brewing, and so it's worth getting in. But you don't want to make a habit of consistently trading those markets, or at least this is my opinion, because the wider spreads, of course, are going to chop you up a little bit in and out. But more importantly, if there's a wider spread, that means there's probably only like one market maker, maybe two market makers. It's not a fluid market. And so even though the transaction costs are a little bit higher on day-to-day trading, what's going to happen when you get that volatile day with, a report's out or there's some sort of news event that hits the market, you might just pull up an option chain and see no bids or asks. So you want to be real careful trading those types of markets with a lot of size. So kind of just nibble in those areas and keep most of your trading to the higher liquidity markets.
Okay. And with that, if anybody has any other questions, please contact Carly. You see her information on the screen. And Carly, I want to thank you again for coming back and doing another presentation for us. I really appreciate it.
No problem. My pleasure.
And for anybody that's looking for the recording, I'll post it on BMT sometime tomorrow, and I'll send it to Carly as well. So you guys that came from her will be able to check it out on her website or whatnot. All right. Thanks, Carly. You really appreciate it, and hope you have a good one. Thanks, guys.
Thanks a lot. Appreciate it.
Bye.